Welcome, Ms. Shari Olefson.
So Rick played the sympathy card with the sinus infection. I don't have any ailments, but we did have a stressful morning. Does anyone remember, I'm going to talk about regulatory reforms, but also legislative reforms. So the regulatory reforms are the things that the regulators come up with, and the legislative reforms happen, more on Capitol Hill. Does anyone remember those Schoolhouse Rock things when we were kids? They used to have one like, I'm just a bill sitting up on Capitol. You guys remember that? Yeah. Okay. So you know what the whole legislative process is like. How many people here have had a baby? Okay. Well, the guy, I appreciate the guys who raise their hand because they sympathize. There's that sympathetic pain. So I'm not talking about the part where you get pregnant because that's the fun part. And I'm not even talking about the part where you are pregnant because you get a lot of attention and everyone gives you their seats, and that's like pretty awesome too. You know, you have this life growing inside you. It's all cool. At least the first time, it's like really cool. I'm talking about the actual labor part, like for 24 hours. That's kind of what it's like to pass legislation. Actually, passing legislation is harder than that. So, and if you are trying to talk about legislation like we're doing this morning, in some ways it can actually be even harder because it's constantly changing. So you can't, like these talking points, I prepared mostly yesterday and then actually got up at 5 o'clock this morning just to make sure nothing else happened yesterday that I missed. And so Rick got caught in that drama because, of course, I have 2 teenage daughters and the printer at home didn't work, and so I had to email it to the office and then run by the office, and we were running late, and then I printed it twice and it came out like 30 pages, and I was like, oh crap, like I only have 30 minutes, I'm not going to be able to cover this, and then I realized it was twice, so we're good. Anyway, thank you for coming. How many folks have been practicing real estate for more than 5 years? Okay, a lot. So you guys knew what it used to be. When I wrote Foreclosure Nation, you see like the dichotomy here, Foreclosure Nation, oh bad, bad, sad, financial fresh start, yay. So yeah, okay, good. So how about for more than 10 years? Okay, so we have a lot of old timers sort of. I've actually had a broker's license since 1989 and used to have a real estate company, so I really kind of understand the dynamics and some of the challenges that you guys have gone through, especially recently. I have a question though. When you think back to 10 years ago, how many people here knew someone who was ever in foreclosure? One person. And how about now? Raise your hand if you know someone who was ever in foreclosure. Okay. All right, so my question, and sometimes we have to look at really the big picture view because we can get caught up in the, all this new legislation and the news and the media. My big picture question and why I write and why I speak and what really motivates me is, as the mother of 2 teenage daughters, if we ask that same question 10 years from now, how many people are going to raise their hand? Have we essentially become a foreclosure nation, or was that really just a crisis that we're really just moving through, and have we really recovered, as everyone would like to say we have? So part of what we'll talk about is that today. Now the good news is there's definitely no shortage of new rules and reforms that are designed to prevent another situation like this from happening. The question is, are they actually going to do that job, and what other types of what we call unintended consequences could they potentially cause? So for example, how many people know what Chris Dodd and Barney Frank were up to right after the crisis? We've all heard of the Dodd-Frank Act, okay? The Dodd-Frank Act, and I'm going to try to, which button do I press? Green? Green button to move the slide?
Yep, just the right button. There you go.
Don't you love it when things work? My secretary called me the other day. She was taping a CNBC segment. She goes, it worked. And I was like, it's supposed to. Like, why are we so surprised when things work? So it worked. So the Dodd-Frank Act actually was aimed at 3 things. First, the goal was to provide stricter standards and supervision to avoid more taxpayer-funded bailouts. The second was to hopefully provide an advanced warning system for problems, if that's even possible. And the third was to improve the regulatory agencies by reorganizing some of those agencies, giving them new powers, and of course creating the new Consumer Financial Protection Bureau. If all of that works, it might be worth it, because the other thing that happened with Dodd-Frank that was sort of not as publicized is we wound up with thousands of pages of new legislation, hundreds of new rules, zillions of studies, probably 60 or 70 new studies that have to be done, new periodic reports, and literally thousands, something like 2,500 new staffers to enforce all of this. The estimated cost for Dodd-Frank the first year to the economy was almost $30 billion, and the 23 largest financial organizations supposedly will be spending about $22 billion a year for the next few years getting geared up to that. Now, we all know that when banks have to spend money on things, eventually it's going to trickle down to us. So again, hopefully it'll be worth the investment, but we'll have to see. There's plenty of other things aside from Dodd-Frank, but we only have 30 minutes. So what I'm going to do is breeze through these and really try to just talk about the rules and reforms that really impact us as realtors and home buyers and home ownership in America. How many people, I mean, just to be honest, when you hear about new rules and reforms, you kind of listen for a second. It's like listening to your accountant. You listen for a second and then you're kind of like in la-la land. Yeah, because sometimes they get so convoluted. So I'm going to try to just break them down and find that balancing point between telling you what you need to know and keeping your attention. So we're going to break them into buckets. The first bucket of new rules and reforms I'm going to talk about is real estate and finance. Then I'm going to talk about taxes, which is actually a really short bucket, so don't freak out. This is the biggest bucket. And then we're going to talk about sort of other. No doubt, because of all the heart-wrenching stories that we've heard about foreclosures and foreclosure alternatives with delayed short sales and people losing their home while they're in a modification, some of the biggest and most publicized new rules and reforms are in the area of foreclosure and foreclosure alternatives. So of course the biggest program has been making home affordable. Everyone's familiar with HAMP and HARP and HAFA by now? Okay. By show of hands, how many people have done or mostly do short sales on the buyer side? Mostly on this, some on the buyer side. How about on the seller side? How about both? Okay, good. Out of curiosity, have you noticed the processes? I know they're not great, but have they gotten better in the last year? No. No. How many people say yes? How many people say no? Okay, okay. So, well, aside from the fact that that impacts home ownership, people's ability to save their homes and buy a new home, it impacts your income, it's also good to know that billions of dollars literally have been spent trying to improve these processes, and a lot of that money comes out of your taxpayer money, so just an interesting notation. But the Federal Housing Finance Authority, during the past year, issued new guidelines for Fannie and Freddie to improve those short sale processes, and as Rick told you before, they're actually doing quite a lot to do that. The other area of big rules and reforms in terms of loan servicing has to do with short sales too, and there have been many new rules and reforms to speed up that process. Actually, some recently passed. There were final rules that will go into effect a year from now, but passed just this past January to require short sale servicers, loan processors, servicers to speed up that process in correcting errors, to be able to justify the forced insurance, all of those things that we've heard about that were problems with servicers for homeowners, responding quicker, the single point of contact, evaluating loss mitigation quicker. All of those things actually have been passed in the past month, are now on the books as rules and regulations that servicers have to follow, and will go into effect between now and next year. The next bucket is, has anyone heard of QM and QRM? Okay, the reason that this is kind of important is they're both rules under Dodd-Frank that will impact the availability of mortgage money. And of course we know that impacts the ability of buyers to buy a home and for us to do transactions. And these two terms are kind of confusing, which is a little annoying because they're really different and they maybe should have chose different words. QM stands for qualified mortgage. QRM stands for qualified residential mortgage. So it does sound the same, but again, they're two different. Here's the 30-second version. Under QM, a creditor cannot make a mortgage loan unless they first verify that the borrower has the ability to repay. Now, you know, when we grew up 5 years ago, 10 years ago, when we started in real estate, it was kind of up to the borrower to make sure they were going to be able to repay the loan. Now, the originators actually have that obligation. The question then became, what is the ability to repay? What do you have to do to make sure the borrower has the ability to repay? So under this QM rule, and the new rule was actually also passed last month, they identify 8 factors that banks have to consider, which are the usual factors, you know, debt to income ratio, mortgage payment, income, those kind of things. But they also identify loan features, which if the loan has these features, it's not going to be considered a qualified mortgage. So you're going to see less of these types of loans. Or if you have a customer who needs one of these loans, it's going to be more costly for them to get one of these loans. And these loans include interest-only loans, negative amortization loans, balloon payments, and any loans with over 30-year terms. Under these qualified mortgages, to be a qualified mortgage, the maximum debt ratio is also 43%. So these laws are really impacting real estate sort of in a behind-the-scenes way. Now, qualified residential mortgage applies to the secondary market. It applies to lenders who securitize their loans. They sell them on the secondary market. And it requires those lenders to retain a 5% interest in any loan pools that they're selling unless the loans are considered qualified residential mortgages. So obviously the banks want to sell all their loans. They're going to try to make sure that the loans that they give to your customers are qualified residential mortgages. And those rules were also published, the proposed rules were published, but those rules will be coming soon. That's something to watch because it means that other types of loans are going to be more expensive and more difficult to find. The other big bucket involves Fannie and Freddie and FHA and VA because of course we know they're behind the majority of loans that we do and the majority of homes that we're able to sell. One issue is a proposal now for state level guarantee pricing. Basically that's the fee that Fannie and Freddie charge to banks when they sell the banks their loans. And in one way or another it gets passed on to borrowers. There's been a recent proposal to change those fees based on states because we've seen, and as Rick said, here in Florida we know that we are costing the government a lot more money because of the large amount of bad loans that we have here. So the idea is instead of charging the same amount for guarantee fees in every state, they're going to charge more in states where the risks are higher. And of course Florida is one of those states. So if that eventually ends up going through, then the cost to get a loan in Florida theoretically would be more than the cost to get a loan in another state where that doesn't apply. So far the states that have been discussed are Illinois, Connecticut, New York, New Jersey, and Florida. The other biggie as far as Fannie and Freddie also of course is GSE reform. We know that there's been a lot of discussion to reform Fannie and Freddie in general, and the Federal Housing Finance Authority, which is the conservator, released a draft strategic plan for years 2013 to 2017 this past year. There were also amendments announced to the deal with Treasury. So the GSEs have to basically wind down their investment portfolios quicker than was originally discussed. And there was also a white paper released by the Federal Housing Finance Authority with comments on the vision for the secondary mortgage market. So all of those are a little more convoluted, they're a little more long-term, but they're all things that are going to impact the ability of our buyers to get loans, significantly impact the ability. The other big player in that space, of course, is FHA. How many folks are doing more FHA loans now than a few years ago? Most people, yeah, they've really stepped back into the market. We've all heard this year, did everyone hear about solvency issues at FHA? They were having financial problems because of all the loans that had gone bad. And, there was actually an act, it was called the FHA Emergency Fiscal Solvency Act of 2012, which died in the Senate. But one thing we can expect this year is more legislation on FHA's solvency and also more regulatory changes. For example, just last week, there were some changes to reverse mortgage rules, which impacts not us in terms of sales, but us in terms of the community, because we do have a lot of seniors who take advantage of programs like that. And some of the reverse mortgage programs that are available to seniors are going to be eliminated April 1st because of FHA's solvency issues. So those are things that really impact our community one way or another. The other thing, of course, FHA made some changes this year in the condo rules. Everyone's aware of those changes to broaden the availability of FHA loans in condos. There's still a lot more needed with that. How about VA loans? Anyone do deals with VA loans? Sometimes, yeah, sometimes. Some of those higher VA loan limits and the ARM programs were also reinstated, so that's good news on the VA loan front. And we're almost through with real estate and finance. Anyone here also have a mortgage license or originate mortgage loans? Okay, so you all know that there's been a lot of change and discussion in terms of loan originator compensation. Dodd-Frank includes restrictions on upfront discount points, origination points, and other fees. The laws that were the new rules that were really recently passed will be phased in between now and January of 2014. And almost last but not least is RESPA and Truth in Lending. Just out of curiosity, how many people remember when the HUD-1 form and the good faith estimate form were revised a couple years ago? You remember. Did it make it easier for borrowers? No, I didn't. I thought it made it very complicated. One thing I did know, because I used to run a joint venture for First American, so I know a lot of people who do residential closings, and a lot of people got out of the residential closing business at that point because they just didn't want to have the hassles of having to comply. There were also a lot of title agents that, with all these sort of, I call them almost witch hunts for bad guys, ended up getting sort of pulled into these investigations and potential lawsuits and things like that because of investors who were doing bad deals. And if you happen to be unfortunate enough here in South Florida, which is, you know, the capital for real estate fraud, to have done one of those closings, you know, you're getting a call from Department of Justice or the FBI or something like that. So a lot of people have gotten out of the business, and the new HUD-1 forms and software was just pushed a lot of people over the edge. In any event, the Consumer Financial Protection Bureau is still tinkering with the HUD forms and Truth in Lending, combining those disclosures, so those will be new forms that you might potentially have to help explain to customers. Also, new escrow requirements on high-risk loans. Your buyers will be required in some instances to escrow for at least the first 5 years of the loan, unless certain exemptions apply. And other protections for high-cost loans for anyone who worked with, you know, higher-risk borrowers that are difficult to get financing. A lot of those changes take place January of next year, so you'll be seeing that. It'll be harder for people to qualify sometimes. And last, of course, is Basel III, which relates to banking. Those are the banking regulations. And again, they're tinkering with the reserves that banks have to keep, which sometimes trickles down and has an impact on us and the availability for financing. That's it for real estate reforms. The tax bucket is a lot smaller, you will note. And this is kind of interesting because up until recently, what's sort of been the overriding theme in Washington? I mean, what have you seen with the robo-signer and the OCC settlement and all this stuff? It's been sort of trying to find the bad guys and punish the bad guys and make everyone know how bad they were and all that kind of stuff. Well, now with the fiscal cliff and all of these rules sort of coming to fruition, that shift is changing. And the focus is going to be a little less on punishing the bad guys and all these reforms, and a little more on a balanced budget and tax reform. And one way or another, whatever your political affiliation is, we know that just like we all had to cut our spending over the last couple of years, the country also is going to have to, one way or another, cut some spending and increase earning. And of course, tax revenue is the way they do that. So I would suspect that if we have the opportunity to meet here next year, this slide will probably be full, and the last one will not have as many new things on it. The Mortgage Debt Relief Act is absolutely my personal favorite. Is everyone familiar with the Mortgage Debt Relief Act? Okay, it's really what helped save our industry. Now, at the beginning of this crisis, I don't know, did anyone work with homeowners at the beginning of this crisis who did a workout and weren't aware that there was no Mortgage Debt Relief Act, and they got a big tax bill? I mean, talk about jumping from the frying pan into the fire. It was horrendous. So this was a great thing. The timing, bless you, the timing to have expired at the end of this year would have just like sucked. So it was extended until the end of this year, and everyone's aware of that, and everyone can tell their sellers that they need to get their act together. The mortgage interest deduction is obviously and has been a particular issue for the National Association of Realtors. How many people think that the mortgage interest deduction is a big deal to homeowners? You know, I wasn't really sure. I thought, okay, you know, maybe not. But something interesting that happened, anytime that I do something like on CNBC or Fox about the mortgage interest deduction, every single time without fail, one of the guys in the studio, and they all tend to be sort of younger guys, like in their 20s or 30s, your typical sort of first-time homeowner, one of the guys in the studio will always, when we turn off the camera, will always say, I didn't know they're thinking about getting rid of that. If they get rid of that, I'm going to have to walk away. Every single time. So the mortgage interest deduction really does matter to homeowners. It's really a game changer that, you know, in terms of whether they can sustain their home ownership or not. Obviously, anytime we talk about taxes, there's not going to be a particular piece of legislation that talks about the mortgage interest deduction. It would be a part of a bigger package, but it's something that the National Association of Realtors is working really hard to protect for everyone. Capital gains taxes and the deductibility of real estate taxes are two of the other obvious ones. Now, in our little book of our little bucket of others, the National Flood Insurance Program was re-extended again for another 5 years, which is wonderful for us here in Florida because our buyers can actually get flood insurance in areas where it's required. That actually, by some counts, will benefit about 20,000 people across the country, about 20,000 communities, and over 5 million individual homeowners and businesses. So that's significant to real estate. The other thing that we can expect to see, especially in light of Hurricane Sandy, is proposals for national disaster insurance in addition to the flood insurance. Our representative from here proposed it when he was in Congress, Ron Klein, and there's already discussions and working groups looking at nationalizing disaster insurance for everyone. Because it's no longer a coastal issue. If you look at where these things are happening, hurricanes and tornadoes and earthquakes and floods, it's not just a coastal issue anymore. The other issue is with appraisals, particularly on high-risk loans. You're going to find that the banks now are required to actually do physical appraisals where they go inside the property. They're going to be required to offer the buyer a copy of the appraisal like 3 days before the closing. There's new requirements where appraisals are concerned. Those also take effect January of next year. Anyone do EB-5 deals involved in that with foreigners? Okay. So President Obama ratified a 3-year reauthorization for the EB-5 deals so that we can continue, particularly in areas like South Florida, California, to have foreigners help us out of whatever's left of the real estate issues. There were some proposals to streamline Section 8 vouchers so that you can get more private interest in and less public interest in. Those did not pass, but because of the increase in the number of renters in the country and because of the increase in rental rates, and in particular Miami, I think it was like over 10% last year, rent rates went up, it was huge. We can expect this year to see some more legislation proposed on helping folks find affordable rentals because that, that is becoming an issue. Probably one of the things that will save our real estate market is rising rent rates because in some areas that, that break-even point where we used to say the rule of thumb was 3 years, you needed to be in a house for 3 years to break even. Because the rent rates are going up and the property values are so good, there are actually some pockets right here in South Florida where that break-even point is only like 1.5 years. And of course we know that the rent-to-own ratio, everyone's familiar with that sort of rule of thumb. If you can buy a house for 15 times what you're paying for rent, it's more cost-effective for you to buy a house than rent. Well, because rents are going up, that's going to drive a lot of people to buy again, which is good. Commercial stuff, there have been a lot of developments. The biggest issue for you all here, anyone do commercial real estate? Okay, so we have some leasehold improvement. Deductibility, the cost recovery for commercial leaseholds was also extended as part of the physical cliff deal, but only to the end of this year, so that's good for our real estate market. So that is actually really it for the legislative and regulatory issues that kind of directly impact all of you. But I would actually like to talk to you about something for a second that's I think is even bigger than the legislation and the regulations. And it's not voted on in Washington or written in books. Instead, it's something that because of the messages that this type of legislation and regulatory reform sends to everyone, it's something that's happening in homes and in our values and attitudes all across America. And my question to you is, well, first of all, how many parents or grandparents do we have here? A lot of you said you've had babies, so I don't know what you did with them if you're not raising your hand. Okay, so we have a lot of folks who have kids and are maybe concerned about their own kids, the next generation. Here's my concern. Tonight, millions of kids in this country are going to sit down at their dinner table and they're going to listen to their parents talk about their home and home ownership and about their bank and their loan and whether or not they can or even want to repay that obligation. I got a call from a friend the other day and he asked if his son could call me and talk about his situation. He was in foreclosure. Now, I mean, 5 or 10 years ago, my friend would have been embarrassed to call and tell me that, but he called and told me that and I was happy to help. So I talked to the son. The kid has been trying to work out something with his bank. He's $17,000 behind in his mortgage with the legal fees and everything like that. Not for any real reason. He just, I don't know what the reason was. He just stopped paying it. And the reason he's thinking about maybe walking away is because they're thinking about moving anyway, and it might just be easier just to walk away and let the bank foreclose than to bother, you know, selling it and paying that $17,000 and yada, yada, yada. I mean, you know, I don't even know what to say. I mean, I sit in a lot of mediations where there are people really going through hardship, who are really trying to save their home, who are underwater, who have kids, who they'll do whatever it takes to save their home. Now, whether it's their fault or whose fault, I don't even care. You know, they just want to save their home. And then you have people like this. I just don't know what kind of messages it is that we're sending to our kids and their peers. And here's my concern with some of these new rules and reforms, most of which I think are wonderful and appropriate. But when you know that your buyer, if you have, how many people have a closing in the next week or two? Okay, your buyers sitting at that closing table will know that thanks to the new loan servicing rules that we just went over that take effect January 14th of next year, they know that their bank is legally required to have a full staff of people sitting there waiting for their phone call in case they want a modification or in case they're having trouble paying, and that those folks at the bank are legally required to consider every possible alternative, and that those folks are restricted. I think it's something like 120 days they have to wait before they can even file a foreclosure action. So homeowners buying, and I'm specifically talking about the younger generation, kids like this, have a whole different perspective about the obligations when they're signing those closing papers at the closing table. It's not as real. It doesn't matter as much. Because if it doesn't work out, there's an 800 number and their bank has to help them. I'm a little concerned about that. I don't know what that means to the next generation's attitudes about homeownership, about honoring your obligations, about financial responsibility, about any of these things. And I'm not drawing conclusions, I'm just putting it out there. We talk about how complicated mortgages and finance have become, and yet how many people remember their grandparents like going to the bank and getting a lollipop or paying their checks, their bills with a check? Those values that our grandparents followed, or our parents in some cases, like be careful who you trust, or don't sign anything before you read it, or you know what, if it sounds too good to be true, it probably is. Those are very simple rules that you can say in a lot less than 2,000 pages and for a lot less than $30 billion a year. So as experts in this field, my question really to you all is, how do we simplify these new, really intimidating rules and reforms? And how do we encourage values and attitudes that we want to pass on to our kids and to their peers? And how do we really engage and empower and inspire average Americans and the next generation to get back on that financial horse, get their financial mojo back, get their independence and their accountability back, especially in an environment where, I mean, let's face it, we're all suspicious and we're all tired of anyone who might have a hidden agenda, like professionals who the general public think just want their business, including realtors, or like politicians who we all think just kind of want our vote, or the media who really is just looking for ratings. Millions of Americans, and particularly our younger generation, are actually considering now whether homeownership even makes sense at all, or is renting the new American dream. I mean, for the first time ever, 2 years ago, banks owned more equity in American homes than Americans did. There's over 2 million new households that are renting, and over a third of those are owners who lost their homes to foreclosure, 40% of whom, according to some surveys, say that they don't intend to buy again. American homeownership in general is now at its lowest level in 50 years. So we have some recovering to do as the real estate professionals. I mean, this is on our shoulders. Who else is going to do it? How do we as experts show people that just in the past year, homeowners have regained over $1 trillion in home equity and personal wealth? How do we communicate that to the general public? How do we communicate that millions of people are rising above water again? And that renting in over 75% of the markets in this country now doesn't make as much sense as buying. You're better off buying. These are all tough challenges, but some of the new rules and reforms that we went over today, some of the upcoming budget issues that will be discussed in Washington are also opportunities for us to engage and to help engage other Americans. Our goal really is to make sure that these policies, these rules and reforms, the tax reforms, the new budget changes actually reflect the values that we think are important and the values that we want our kids and their peers to see. And we're in a position, particularly with the National Association of Realtors, to really do something about it, because the National Association of Realtors is a big guy in Washington, and they listen to you. So in the quest to overcome these challenges, it's really up to us. I mean, we are realtors, mortgage people, people in banking. We are the experts, and we are uniquely positioned to really help empower people to connect the dots between what's happening in these regulations and reforms in Washington and what's going to end up happening at dining room tables and in kitchens and in the minds of folks in their own homes across the country. You can help average Americans access accessible home loans and home ownership and the new consumer protection tools that, I mean, frankly, we've all paid hundreds of billions of dollars in taxpayer money for out of our own money. So that's great if you're all prepared to rise to the occasion. And I think, by coming to something like this today and listening and learning, we all clearly are. Anyone who has questions or ideas or thoughts is welcome. I would love to hear what you have to think, Twitter or on our website. And I thank you for coming today and wish you guys a great 2013.